The last 48 hours has seen a significant repricing of the October the 30th meeting as a result of the non-manufacturing ISM data that we saw on Tuesday. I think we're now at a circa 80% chance of a cut by 25 basis points at that meeting. Is that an overreaction to one piece of data?
Well, I think it was an important piece of data. I don't know if it's an overreaction. I'm open-minded about the decision, and we'll learn more before the meeting at the end of this month. But I would say that the ISM number was, a negative number for manufacturing. We'd received a number of reports over the last many months about trade uncertainties, about how manufacturing enterprises were a bit reticent to expand capacity. Capital expenditures have been very weak. And so I think it is a little more confirmation of the reports that we had been seeing. And I think it'll be very important to see the progression from here.
Enough to tip the FOMC towards a rate cut, though. Manufacturing is not a huge part of the U.S. economy, but it is a significant part of the U.S. economy.
Oh, it certainly is. And in my Midwestern district, we have more manufacturing than the average. And so I've heard more reports about this and the weaknesses and what comes from the trade uncertainties. But I would say that thinking about monetary policy and what the right positioning is, I definitely think that the FOMC has been moving to what at one point last year looked like headed for slightly modest, restrictive position. Now we have an accommodative position, and whether or not one more rate cut at this point is the right decision or not, I think we're just going to have to go into the meeting and see. Have a discussion about that.
Data dependent.
I think that's right. It sounds like we say that all the time, and we're always looking at the state of the economy, but that is the job. And there are many fundamentals that are really quite good for the U.S. Consumer spending has been good. The labor market has continued to be good. It's moderated a little bit recently, but the unemployment rate is 3.7%. So there are good fundamentals, but it's definitely the case that business spending has been weaker.
The consumer is important, as you indicate, for the U.S. economy. Nevertheless, if the Fed waits until there are signs that the consumer is beginning to roll over, isn't that too late?
Yeah, I think that would be an important concern, and that's one reason why the committee has tried to get out ahead of this. We've repositioned policy from being headed for slightly restrictive policy to one that's accommodative, and the question is how accommodative we need to be. At the moment, it's still risk management. I would say that the weakness in the ISM and in manufacturing is something that definitely increases concerns. I'm definitely looking at that data, but at the moment, it still looks like, my outlook for this year is 2.25%, and next year is about 2%. Trend growth is 1.75%, maybe 2%. So, this is a pretty good growth outlook. The question is whether or not we're going to be able to navigate the uncertainties and some of the shocks that come our way and get that growth path, or whether or not there's something else that pushes us to the side. So I think that's why we've moved to a more accommodative policy, and we'll have a discussion as to whether or not more is needed at the end of the month.
You are a voting member, though, and it would be remiss of me not to ask if the manufacturing data on Tuesday edged you closer to voting for a cut in October.
I think it sort of comes down to whether or not my outlook changed, substantially, and it's only one number. It's a progression of not positive numbers from manufacturing, and as I said, there are business reports that have definitely made me nervous about that. That's why I have, full-throated supported the move to a more accommodative stance. We've cut twice this year. It's even a bigger move from a restrictive standpoint when you think about what we were headed towards as of the end of last year. And so I think we're well positioned for modest adjustments in headwinds to the economy. If something more severe happened, we'd have to make more adjustments.
What's stall speed for the U.S. economy?
Stall speed?
Yeah.
Oh, that's not really a concept I'm, that well versed in quantifying. I mean, I think that, like I say, I think fundamentals are, looking for 2% growth going forward over the next several quarters. I think that's good. That's actually slightly above trend, so that's not stalling at all. And I think the labor market will be very important. I would expect some moderation in employment numbers because the labor force participation rate has increased already. It's increased a lot, and businesses continue to tell us that they're having trouble finding the workers that they're looking for. They are competing for them, definitely at the lower skilled levels, but it's not showing up in strong wage pressures, and so there could be some more room to run for labor markets, but we're at a very mature expansion point.
Break-evens continue to push lower and lower and lower. The market isn't indicating that the Fed is going to hit its inflation target. Is that a concern?
I'm very concerned about the inflation outlook. As a matter of fact, I would have argued this spring that even before I was nervous about economic headwinds, there was a good argument for more accommodative monetary policy just to ensure that we get inflation up to 2%. I think we should be overshooting 2% at this point in the economic cycle. We've underrun 2% for quite a long time. We've indicated that our objective is symmetric. We should spend time above 2% as well as below 2%. We should be averaging 2%. We've had trouble getting to 2%. We haven't averaged 2%. So I think if we took actions to ensure that we overshot 2%, 2.25%, even 2.5% is not really a challenge given symmetry of our objective, then you would be more assured that you would get to 2% if you found headwinds. So if you try to aim higher and then you're knocked down a little bit, at least you could get to 2%.
Yeah. So do you think monetary policy therefore needs to be even more accommodative, given kind of where we are now, given where break-evens are, and given where they're signaling that we're going to go?
So I put all of these considerations into the mix, and I've got those two reasons, that inflation has been underperforming, as well as the risk management aspect. Even though the unemployment rate's 3.7%, even though I'm looking for trend growth, I think the headwinds are stronger than I was expecting earlier in the year and late last year. That also argues for the accommodated moves that we've made. I'm going to go into the meeting, listen to everyone's perspectives, firm up my own about the outlook for the economy, and ask myself, do we really, do we need still more accommodated monetary policy to achieve these objectives, assuming that we are still going to be able to navigate the more minor shocks that are going to come our way over the next 6 to 18 months.
One of the major shocks has been trade. And the slowdown that we are seeing in global trade. To what extent do you think that the manufacturing number we've just seen is down to the fact that we are seeing the current trade environment feeding through into U.S. companies?
I think the trade uncertainty has been very important for the weakness in manufacturing. I've talked to so many business executives, manufacturing executives who have indicated that there's just a good deal of uncertainty. One way or another, the conversation sort of dances around concerns about supply chains and where they're located, how many times they have to cross the border in order to, achieve their strategic aims as they've laid it all out. They have enormous investments already in place. If they had to redesign those and reinvest, first off, they'd have to know where to reinvest for those supply chains, and it would be, quite a capital loss if they, had to completely redo it. So in that environment, I think that everybody's been much more cautious, and we haven't seen the increase in business investment that we had expected on the heels of very aggressive, strong tax cuts and corporate tax reform. The architects of tax reform were, strongly suggesting we would see an increase in business investment, and we have not seen that. Something else has held it back, presumably, and trade uncertainty is clearly one of the things.
Have the cuts that you have delivered thus far been to offset that?
They've definitely been trying to pre-position to make it a little more attractive, certainly to ease concerns that businesses would have. It's very modest repositioning. It's not going to all of a sudden be a panacea. If uncertainties, if there's another shock that provides substantial headwinds, our modest policy adjustments are not enough to offset that. So, but I'm still optimistic that something will happen there.
Let's talk about the repo markets. Those of us that covered 2008 certainly saw elevated heart rates when we saw the overnight funding costs shoot through the roof. Did yours get a little faster as well?
Well, I think that the volatility in repo rates, money rates, was unexpected. I think that you could have easily expected that there were corporate tax payments that were on the calendar from a long time ago. I think that the way that money flows out of corporate bank accounts, and then it's off to the side to make those payments. Then it ends up in a treasury account that's not in the bank. So the level of reserves that were available for funding repo operations were not as high as we might have thought. They were also very concentrated in a small number of very large financial institutions, and the willingness of institutions to arbitrage these small changes in spreads and sometimes large changes in spreads is a little bit different than I might have guessed they would have been years ago. And so I think that the regulatory environment has adjusted things. I think that the structure of financial markets has also evolved to a point that we need to better appreciate what the size of our reserves should be in this environment to help provide consistency of the support for repo and all of that. So we'll be looking at how we should be calibrating that.
There's likely to be another similar environment at the end of the year. Can you say with a degree of certainty that the Fed will have made adjustments to its balance sheet and the New York Fed will be a little bit more alert, that will not happen again? Are we not going to see a similar environment at the end of the year?
We're going to have many conversations about this. I think the New York Fed, I think the desk has been very aggressive. I think they put together some very strong programs. Like I say, I think you could easily have expected that there would be these funding issues, but the greater appreciation for how the reserves are concentrated, for how certain players don't have the same incentives to arbitrage things like they did in the past, and what that means for how we should design our reserves and perhaps augment this level. We have been, as a committee, trying to better understand what the efficient and effective size of our balance sheet should be, and so I think we have to ask whether or not it should be a little bit larger. We need bigger buffers. Even then, we have to understand how those reserves are allocated across different financial players who are willing to arbitrage those rates. There are many issues in play. I know we heard a lot of commentary from participants in the financial markets. I never quite heard from those commentaries, this is exactly what you need to be concerned about, that they're in this place, not in this place. I mean, I think we're all learning about that.
Chicago Fed President Charles Evans, thank you very much indeed.
Thank you very much.